Howdy, everyone. This episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them from me later in the episode. But now, on with the show. All right, everyone. Welcome back to another episode of On the Margin. This is a bonus episode. Really excited for this one. I've got Danny Masters and John Cheesman on here with me. What's going on, fellas? How you doing?
Hey, Michael. Good to see you.
Good to be here. Thanks a lot, Mike.
Guys, it's been a little while since I last saw you in person in London. We don't have our Carlsbergs on us today, but we'll have to soldier on anyway. What's going on in your neck of the woods?
Well, just got back from St. Moritz last week. You know, I think it's one of the more obviously up there with Blockworks. It's one of the more prestigious conferences. It's actually throttled in terms of attendance. That was acutely so because of COVID, but it was heavily oversubscribed. Just a really great opportunity to get a face-to-face with a lot of the people who've been building in the crypto space. Some of the big names like Aave and Maple and on down that list. Good to see everyone in good form there. And, just a super busy, super energetic conference. Obviously, that predated the recent price slide, but I think, we've always got to keep our eyes on what's actually being built. And that was a very positive takeaway from that conference.
Mm-hmm. Absolutely. We're all in it for the fundamentals in the tech now, especially when prices are sliding. Right? Exactly. Okay, guys, I'd love to cover two topics with you here today, right? So we've got the FOMC meeting coming out on Wednesday. This will be released on Tuesday. So I want this to serve a little bit as a preview for the FOMC meeting, right? What can we really expect here? And talk about how you see the Fed reacting in 2022 to kind of various pressures that are coming up right now. And then I'd love to get your thoughts on how crypto is being influenced by more macro forces, right? It seems like they're really moving in lockstep these days. So I don't know, how do you guys think about how much leeway the Fed has actually to tighten, and what can we expect from the FOMC meeting on Wednesday?
Well, let me just kick off just real quick, because I think, it's not obvious to everyone how we end up with this relationship between, QE, Fed, tightening balance sheets and crypto. And I think it's really important to frame this because, we can't lose sight of the sort of long-term trajectory that I think we're on. And this is, mindful to me from a personal connection of mine and friend to CoinShares, Kevin Walsh, who's been, very, very intimately involved with Fed policy, for long periods of his career. And I remember him, coming to crypto early, about 2012, something like that, and talking about his views as a central banker, and a really prominent one about crypto. And he described crypto as being the reaction to quantitative easing in 2008, following, the world financial crisis and the banking collapses that we saw. And he felt at that time, and I fully endorse that the future trajectory of crypto would be determined by how we actually went ahead and unwound what was at the time an unprecedented loosening, largely from the Fed, but also echoed by other central banks. And the bottom line was that between sort of, the end of that aggressive cycle, sort of 2011, 2012, and the sort of immediately pre-COVID period, which I suppose, was 5 or 6 years, we really didn't do very much at all to reduce that balance sheet. And I think that came about because what emerged was that there was an increasing sort of politicization of central banks, where central banks, which I think for many, many years held themselves as completely independent from the financial system or whatever governing party that they had, somehow came back into this political governance. And then we had obviously COVID, hit. And then, what was supposed to be a deleveraging cycle was reversed to be an even bigger, easing cycle that dwarfed, quite frankly, what happened in those, post-world financial crisis years. And so, we didn't pay the piper, round one. We didn't pay the piper round two, and actually the stakes, have gotten a lot higher. And if anything, that politicization of QE and banking policy, particularly around, the pandemic and what that meant for sort of social constructs, has pushed the banks and the politicians ever close together and in unison in almost every major country in the world. And so, we've come a long way through that. And I think we can ask the same question today as Kevin was asking in 2008. I think the future trajectory of crypto depends on how we go ahead and unwind this astronomical sized balance sheet.
I guess one of the points to make there is, the Fed really has two mandates, which is inflation and employment, but it also has kind of a third mandate, which is financial stability. The pre-COVID period that Danny was talking about, or even I suppose it was right until just before COVID when prices slightly started to pick up, and you've had this long period of very low inflation. There are a number of really kind of long-term macro factors, demographic changes, globalization, and also the infotech revolution. All these are extraordinary, powerful disinflationary forces, and so for a very, very long time, the Federal Reserve was panicked that they were going to become Japan, and they were just unable to stop deflation. And I suppose I suppose probably from about 2013, 2014 until 2020, that was really the big concern for the Fed. I remember, Danny's talking about Kevin Walsh. I remember I watched an interview with he was working for Stan Druckenmiller for a while. I watched an interview with him and this was I guess this was probably I think it was in 2017, and he was saying that crypto was a solution looking for a problem, and that was why he wasn't convinced that he'd do anything more than kind of dabble in the token economy. Did a few bits and pieces, I think. And then, of course, the economy was actually picking up quite well, as Jay Powell reminds us, into COVID. And then we just had this unbelievable shock, which resulted in the biggest expansion of monetary policy that we've ever seen in GDP terms since World War II. So it really was, a wartime response to what happened in COVID. And I remember Jay Powell went on David Rubenstein's program on Sunday night. I think it was in June of 20, and he just said, really, we're just going to do whatever. The economy was in good shape. People had good jobs. They'd had businesses they'd invested in for a long time. It is my job to make sure that through this we get to the other side of this pandemic in the same position, to get those people in the same positions to continue to run their businesses, to keep their jobs, to keep their livelihoods as they were before. And I think this just lasted for so much longer, and that meant that the monetary expansion was that much bigger. As we now come to the other side of it, the problem is that we've now created a huge amount of inflation. There's a big debate about, how long this inflation will last. The idea that it would be transitory in the definitions that the Fed first came out with were definitely wrong. It may be transitory on a longer time scale, but on that time scale, it was definitely wrong. And we're seeing, really, really persistent inflation in housing, in autos, in energy, and in wages, which is, I think, wages is probably where the Fed is most worried right now, because energy, used cars will probably be temporary. Energy, it can't really do anything about. But wages and housing are a much stickier problem for them. So going back to what Stan Druckenmiller was saying, that when he saw the big monetary expansion, he said, actually, crypto was a problem looking for a solution. A solution looking for a problem, but now it's found that problem in what the central banks have done. So these guys, Paul Tudor Jones wrote that long paper about monetary inflation. Stan Druckenmiller changed his mind. You can be sure that meant that pretty much every other macro trader in the world changed his mind too and was buying crypto. So now when you get to an environment where, no one really knows how much they're going to tighten, when they're going to tighten. But let's be clear. If it's a kind of binary, they are tightening, not loosening. Like that is very clear. And how does crypto react to that? Well, I think those macro guys that did well and made money trading crypto as a monetary inflation asset, well, it's they're not investing on a monetary inflation playbook anymore. So they're looking for other trades that will do well in a monetary tightening environment, short rates, short equities, probably even short crypto, though I haven't found anyone that generally kind of thinks that crypto is a shortable asset. So that's kind of I guess where we are now. I feel like the investment community and banking community, like bank forecasters, are getting very far ahead by talking about 4 hikes, balance sheet runoff, because you can see already the Fed has just hinted at what it's going to do. The Fed is in fact still doing QE, albeit at a slower rate, and we're already seeing this turbulence in markets. I don't think this turbulence in markets is enough to shock the Fed yet, but take it to April, where it's been like this, they've actually tightened twice. I mean, markets could be much, much, much lower. And of course, in a financialized economy, which we've never seen a financialized economy like this before, nothing will create or reduce inflation more than a drop in asset prices. So, and financial conditions and asset prices are very tightly closed. So, so I kind of, I feel like there was a very, very hawkish consensus, i.e. more rate hikes coming into this meeting. I don't think we were going to get that. Similarly, there may be some people who are now looking for him to really ease off because of this small turbulence, or it's not that small, but the short-lived turbulence you've seen. And I think probably it's going to be somewhere down the middle of those.
And I'd get even a little bit more specific, and I'll tell you what I think. I think that there is now an unholy alliance between politicians and central bankers. I don't think that's ever going to go away. There seems to be no political route by which you can unring that particular bell. I think the number is, stock market down somewhere between 15 and 20%. Now, whether that's the FANGs or NASDAQ or the Russell 2000 does make a difference. Because some of those stocks did get ridiculously extended. But I think that's probably around. I don't think the Fed has the stomach to watch the stock market go down much more than that.
Well, yeah, because one of the sort of theories of the market is that on Powell's renomination, him and Biden kind of shook hands that into the midterms, the Fed had to address this. Well, the Fed and the government had to address this inflation topic because that was becoming so politicized, and the Democrats were clearly, among other things, in a lot of trouble for that. I just don't see how the solution from them looking like they're doing a bad job on inflation to asset prices going down, and that all of a sudden makes them look like they're doing a good job. I think it's a very tough situation. And one of my friends jokes actually that the Fed now only really has a choice between deflation and dog coins. And I think, as crazy as it would sound, I think they probably go for the latter.
Yeah.
That's certainly the world I'd rather be in.
Yeah, dog coin. Yeah, Shiba to the moon. I guess my question is, there are other a bunch of analysts have kind of framed it that way. There's an analyst at Bank of America who I really like, Michael Hartnett, who's basically called for a little while that, the Fed is going to have to choose eventually between inflation and some sort of, consumer recession, basically. And that's why I was kind of, wanted to frame this discussion as slowing structural growth in the economy, right? So when the Fed is kind of weighing, two kind of bad outcomes here, like Scylla Charybdis or Fire and Ice, or however you want, whatever kind of theatrical framing you want to attribute to it, it does kind of seem like they're in the situation where there isn't much underlying structural growth. So they have this decision to make, inflation is kind of rearing its ugly head. Is it more important to fight inflation or do we want to avoid some sort of consumer recession, right? And both of those seem like very unappealing outcomes, I suppose. So do you think the Fed is framing it that way in their head? Do you view those two things as like the two outcomes that we could possibly have in 2022? Like, how would you approach that question?
Central banks tend to be quite gradualist, much more gradualist than the market. And probably the worst trades I've seen is where the market just wants things on a quicker timeline than central banks end up delivering. And I actually think that the short rates trade is going to end that way too. I think the Fed officials genuinely believe that inflation is going to come lower naturally. I think that they're clearly must be somewhat frustrated that it hasn't happened yet. But I do believe that they do think that. And, you think about something like, people talk about energy prices a lot. Well, nothing the Fed can do about energy prices anyway. And energy prices actually tighten the economy anyway. So even if you're getting, even if you get an energy price issue. There's like literally nothing they can do about that. So that won't even be on the page. Yeah, I mean, I think that they'll be concerned that this inflation is so stubborn. In some ways, I think at the back of their minds, I think they know that because inflation is such a political hot potato now, for them to do anything requiring easing, they need a really clear excuse to do that. And that's sort of what Danny was talking about, the Fed put, as you will. And as a result, I think that's become the market consensus, where in the post-COVID period, a 5% drawdown in the S&P, we've had a few of them, have just been a very clear buy. It's never gone through there. I haven't looked this morning. I think we're probably down about maybe as much as, not quite as much as 10, probably 8 or 9% down in the S&P. So we're through that. And one of the things that some of my former colleagues that I chat to a lot have noted is the two factors we've seen now is retail have started to sell rather than just, buy the dip as they've got used to. And also CTAs, which follow momentum, are now selling as well. So, and I think that's the same in crypto. You've got people who've made a huge amount of money in it, who tried to hold on and couldn't hold on anymore, are selling. There are definitely liquidations going through the market. And you just have a bit of a, buyer's strike. Russia and Ukraine is looming over as well. That's looking incrementally worse over the weekend. I think all the believers have been, have worn a huge amount of pain, be that in growth equities or crypto. So, and the kind of non-believers are probably, thinking they're going to turn the market's going to turn the knife a little more before they see kind of value in these trades. And that's where I'm absolutely, I have to say, I'm usually pretty kind of balanced on kind of market outcomes, and I'd kind of could see there were certainly signs of froth, as everyone could, I'm sure, last year in crypto. But the fact to have come pretty much back to where we were at the lows last summer in Bitcoin and Ethereum in this quickly is pretty wild. I mean, just looking at, year-to-date returns, I mean, Solana's over 50, Ethereum's 40, the total market cap's 33, Bitcoin's 30, and and it's only, we haven't even finished January yet. I mean, that really is a sharp move. And actually, one of the things that I've been looking for signs of kind of, so if there's a buyer's strike, what you have to then wait for is kind of seller's exhaustion. And one of the trades I've been things I've been monitoring for that is for Ethereum to underperform on a vol adjusted basis, which it has been today actually. And I kind of feel that's the latecomers to the kind of 2021 market. I feel like Ethereum would be the last one that they'd sell, because I think they sort of avoided Bitcoin anyway. So I feel, and they would have sold the riskier end stuff and then eventually get to Ethereum. So yeah, but it's you'd hope that with a more institutionalized user base, though that was always in the kind of developmental stage rather than the live stage, that that there will be kind of fundamental value based investors looking at crypto.
Yeah, I mean, I'd just add to that. I mean, we've had a pretty sublime run going all the way back to, I think, the seminal moment of Paul Jones's letter, which I think was the dawn of institutionalization of crypto. Yeah, we had a decent short, sharp shock in terms of COVID, and then some pretty spectacular runs. And I think let's face it, the community within crypto has gotten a lot broader. It's gotten a lot bigger in terms of number and in terms of size. And a lot of that cohort, did not experience 2010, 2012, 2014, 2017. This decline in crypto is actually a lot more orderly than a lot of the declines in crypto we saw in the past. And I think that's got a lot to do with the market structure, the fact that there's more liquidity, there's more venues, there's more players. There's arguably a little bit less leverage, I think, just in per head, as it were. It used to be very much all in or nothing kind of game. And so, whereas we might have seen, crypto go from 1,000 to 200 or 5,000 to 2,000 and all these various cycles, you will have never seen my name on a when crypto 100, when Bitcoin 100,000, when Bitcoin 1 million type of post. I've never really been like that. I'm a bit more cautious, and I obviously naturally long exposed to the business anyway. So it takes a little bit more for me to want to get speculatively involved and get longer, as it were, crypto. But I'm actually feeling like this might be the kind of buy area. I agree with John's assessment. I think there's the first signs of some form of capitulation. I think this is a big correction that we've had. And when you look at the options, the outcomes that we have going forward for the Fed, as you put it, consumer recession or inflation, none of these are to be savored. And I think that as they oscillate and react, stock market down, back off, stock market up, feed it back, inflation up, feed it back, you can see them going on a sort of potentially going on some sort of recursive pattern here that sort of leads to a little bit less confidence and a little bit less understanding of what the true direction is. And I actually think that does speak to crypto. And like you sort of partially joked before, Mike, I think the other thing which is probably lost on people who are here for the last couple of years, not the last 5 or 6 years, is that, during the retreat in 2017-18, I mean, the actual technology available was non-existent. I think there is a really stark difference between the deliverable technology you see today and the impact it is clearly having and going to have. Business models like DeFi, Metaverse, Play to Earn, Earn to Learn, all this kind of stuff that are new business models made possible only by crypto were just pipe dreams in 2017.
Yeah.
So I'm encouraged by a big decline. B, I'm encouraged by the first signs of capitulation. Now, look, if the S&P takes another 10% leg, those bets are off, and we'll have to reevaluate that whole thing. But I'm aiming, if I'm not shooting, I think at this moment at sort of trying to up the risk. And I think I think the other thing that has to be noted is that the choice of crypto has gotten so much bigger in the last sort of 6 or 9 months. And a lot of these, I think, are a little bit more hope than reality. I mean, at the end of the day, Ethereum has a vast infrastructure that is extremely difficult to compete with. It may not be the most feature-rich crypto in the world, but it's certainly the most robust one. And I think it's, again, thinking about Arthur Hayes' letter recently, which I think was looking pretty apocryphal at this moment. Again, he saw this thing as very much being a shrinkage in all coins and an initial move back into Bitcoin and Ethereum, and I would echo that.
This episode is brought to you by Fireblocks. I talk to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same 2 problems. 1, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. 2, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They are a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you.
Danny, can I pile on and ask you your thoughts here? Because one observation that I'm kind of chewing over in my own head here, and you've seen more market cycles than I have, but one thing that I kind of observed is I wonder if this is actually an area of bias for crypto OGs in some way, because a couple months ago, back when everyone was very confident that the bull market had resumed, a lot of people were calling for a blow off top at some point. And actually, I think it was actually more crypto OGs who were calling for that because that was what their past experience had told them, right? Every crypto market, bull market up till this point, it had a blow off top. And we didn't really get that. What we got was kind of this rounded, elongated kind of top,
right? So I wonder if this could actually be an area of blind spot for folks who've been in this market for a long time. They expect this, in that exact blog post that Arthur Hayes wrote, the Maelstrom, he called it like the desperate puke out candle, right? Which is, Bitcoin going from, 19K all the way down, down from that $6,000 level to $3,000. I wonder if we're a little bit blind in expecting that, but maybe we actually don't deserve it.
Look, the lesson in marketplaces is you what you get kind of rhymes with what you think was going to happen, but may not be exactly the same thing.
Right.
And for me, I think we did have a blow off top. We just had a blow off top in coins that people aren't really focused on in terms of their relation to Bitcoin and Ethereum. Look at coins like crypto.com, a decent exchange, a decent wallet, but it is a far, far distance away from Coinbase. Peaked at around 25 billion market cap for that network. And I think that's probably down 60 or 70% now. And you can go down the list of not just the cryptos, look at the equities, look at where BAT stock was 6 weeks ago, 13 billion valuation, $65 stock, now trading 5. All right, so don't mistake the fact that we had a blow off. It just wasn't in Bitcoin and Ethereum. It was in the ever more hopeful, ever more risky areas, and the stuff that was super, super high momentum. And there's been some serious damage done in those coins.
And I think also the other thing as well is you can only really have those crazy blow off tops in assets that are a bit smaller. The market structure of not only is the absolute market cap of Bitcoin and Ethereum much bigger than it used to be, but the market structure is also, more participants, deeper liquidity, better liquidity venues and things like that. So there have been some real structural changes to those markets. So, as Danny completely correctly says, the signs of the blow off top come in things where there isn't that same, I suppose, one of the things is just not as many eyes on it. You can't have a lot of eyes on a market will reduce the kind of extreme volatility of it.
Yeah.
But speaking of extreme volatility, like just what the market's braced for now from looking at the VIX, which is now up at 30 and doubled on the year. I mean, we've had a huge move in equities, but no one is stepping in to sell vol here or buy the dip. So I've been kind of thinking, hopefully since the end of last week, that some of this selling, even in equity markets, let alone crypto, is coming at a very kind of into a very, very illiquid market structure.
Well, just as like a sentiment check here, I prepared these charts, but I'm not going to go through all of them. But this was a pretty stark chart for me to look at, actually, which is that investor sentiment right now is actually more bearish than it was at the March 2020 bottom, which is a pretty wild statistic for me. So I'm not really sure how you guys interpret something like that, because, at the same time, I understand that, depending on your view, right, that all financial assets have basically, the Fed has blown a bubble into all financial assets right now. And I think people are very concerned at the unwinding of that, particularly into a not great economic environment. But it doesn't seem justified that the panic should be worse than a potentially world-ending pandemic. So I'm just curious, when you guys look at a chart like that, what your reaction is.
Well, I think into this year, everyone was pretty concerned. You knew that the Democrats weren't going to get any more fiscal stimulus through, and that we had a huge amount of fiscal stimulus. We'd actually had a pretty good year growth-wise. Everyone assumed that would slowed. Also, everyone's expecting the Fed to tighten, and you're on the back of. The S&P was double what it was on the March. So I think kind of it's partially explained just from a level perspective that, in March there'd already been a bit of a sell-off. And now I think just coming into this year with those three major inputs for the bull market removed or even reversed, I guess that's why.
Yeah, look, every decent sell-off, we've got one now. Well, the last one we had was the March COVID sell-off. Every one we have, it sort of always looks like the end. The VIX spikes, the sentiment goes bearish. The market, the chart falls off a cliff, breaks a couple of supports. If it's not the 50, it's the 100. If it's not the 100, it's the 200. And I sometimes kick myself afterwards and I'm going, you know what? If I'm going to do one thing, I just have to wait till everyone's absolutely nervous and panicky. And it's super, super nasty sounding. I mean, this whole podcast is pretty kind of, doom speaking stuff. And sometimes, you just got to hold your nose, and that's the moment you dive in. What you've got to be careful not to do, I think, is go all in at a time like this, because there could be a bottom below this bottom and a bottom below that bottom too. But, I'm going to hang my hat on the things I said before. Number one, I really believe in this tech, and I believe, for the right infrastructure supported coins and networks, there's a really, really bright future. I'm going to take a little bit of comfort from this bearish pall that's hanging over everything, and I'm going to take a little bit of comfort from the idea that with these Fed choices we have going forwards, I'm not sure if it gets to the right solution or the wrong solution, but I'm sure it's going to undermine further the confidence in what that institution does, and I think that's good for crypto.
I would widely agree with you there, Danny. I think maybe, so we've been talking a lot about what's going to happen in 2022. I think zooming out in general, the big question to be asking is, do you think that we're going to be moving towards an environment where we have sustained negative real rates, right? Because it certainly does seem like we're moving into some area of heightened inflation, right? I think the question is what do rates do in that environment, right? So, I mean, my thought has always been, I just don't see a world where the Fed can normalize just purely because of the amount of debt that we have, but also just if you think about, if I try to put myself in other people's shoes, maybe that's not the smartest thing to do, but I try to put myself in the shoes of what the Fed has done. If you go all the way back to 1987, right, Black Monday, and you look at how the Fed has responded to various financial crises, it's pretty much always been the same playbook, right? So 1987, right, you had the bailout of long-term capital management, right, in the late 90s. Then you had 2001, then you had 2008, then you had COVID, and it was basically all the same policy. So I think the muscle memory of just whenever there is some sort of turmoil or financial trouble, you ease monetary accommodations. And if you put that against the backdrop of everything that we were talking about in the beginning of this, like population demographics, not looking very good, debt, not looking very good. I don't see an environment where we actually get what the Fed really wants, which in my opinion is growth, right? So both of those factors kind of, to me, paint this environment of negative real rates. So I know we're all very concerned about Fed tightening for the moment, but for me, the overall backdrop, let's say over the next 5 or 10 years, is negative real rates. I'd be curious to see what you guys think of that as a framework, and if so, how does that translate to markets?
I mean, I'd just say, embedded, obviously there are two parts of, calculating a real rate. And at the moment, I think everyone agrees that kind of spot inflation is going to fall from where it is now, pretty significant. Even if we end up in a much higher inflationary environment, spot inflation is going to halve. So that obviously will naturally, as you say, push real rates lower.
Yeah.
So they'd have to tighten 4% in order to have long-term positive, so there really is a big tightening cycle needed to, by the end of this year, or say in 18 months time, to have positive real rates is a real challenge.
Yeah, and I think sometimes people forget the simple stuff, which is that interest rates, and more importantly, real interest rates, are the price of money. And when you have too much money, the price goes down, and there's not much you can do to escape that.
Really well said. I've got one final question for you here, and this is something that I'm just a little bit curious about, honestly. And we talked about this a little bit at our closing fireside at DAS London, but a lot of the times when people make the connection in between macro and crypto, they make the connection of Bitcoin, right? Danny, this is what you were talking about with sort of the Paul Tudor Jones, connection between price of money going down, negative real rates, and Bitcoin kind of being a hard asset that you want to own in that sort of environment. But a lot of what has been actually very interesting over the course of the last, let's say, year and a half, like the tech and some of the other new projects, right? Like Ethereum has nothing to do with that, right? That's not the story of what Ethereum is trying to do in general. And for me, I actually start to see other sort of macro indicators that might be positive for something like Ethereum, smart contract networks, et cetera, which is like antitrust going on for big tech in the US. Like Liz Warren is really bearing down on Google and Facebook. And there's been a pushback on deplatforming on big platforms like Twitter and Facebook and YouTube. And to me, those are signposts for maybe not the sound money narrative of Bitcoin, but the Web3 narrative of a more open, democratized internet that is fair and kind of absent from these monopolies. So I guess when you guys think about macro indicators for the non-Bitcoin section of crypto? What are some of the first things that jump to mind for you?
If you guys didn't catch, there's one of the crypto Twitter people, supertrooper.eth, as in, the big spotlights on the stage, put out, once in a while you see one of these things and you kind of just realize how rapid the progress is and how much of it sort of passes you by in your day-to-day life. And he put together the ecosystem for decentralized music, which you're sitting there thinking, oh, it's Audius and a couple of NFT, things. But the ecosystem for the decentralized music universe has absolutely exploded. And I think Melton, my colleague Melton Demiras, put it on her tweet feed if anyone wants to go back and look at that in the last couple of days. And I think that, there's the sort of deplatforming that you're talking about, Mike, right? How many years have we gone through the record label fights and the East versus the West and all this kind of stuff? I think that there's been a lot of people making attempts. SoundCloud tried and failed to deplatform a lot of these big music type institutions. But that is really happening now. And if you look at the metrics on what's happening with Audius and how quickly their user base and their activity is growing, and what extra features that their platform offers to artists, performers, and fans, it's absolutely staggering. And I think I think music. When we talk about business models made possible only by crypto, I think music is going to absolutely explode out of that soon. And I think one after another. This is going to be the new model, whether it's social media through DeSo, music through Audius, publishing through Mirror.xyz. Every single industry, which I think has been platformed, and if they weren't platformed with the old companies, they were platformed with the Twitters and the intermediators who then also ended up kind of having a bit of a stranglehold. And now I think they're all going to break free, and I think that's part of the bright future that crypto has.
Yeah, I just add to that. Crypto is kind of a financial currency asset or monetary asset, and it's also a technology asset. And I think there's a spectrum of assets that look more like monetary assets and more like technology assets. So when you have a change to one of those conditions, which is more likely to be, I suppose, the monetary policy side, those assets or the macro type, the assets that macro type investors buy are likely to be the most sensitive to changes in that. And actually the technology type assets that the kind of long-term VCs and people like that are looking at might do better in that environment. But of course, there's kind of a correlation that runs through all of them, that these are kind of, as much as it is changing technology, they are also all monetary assets too.
Yeah, and then one also needs to be quite mindful in this kind of environment. When the market is under pressure in crypto, there are usually some landmines around. There are some people that get over leveraged, get liquidated in some of the less liquid instruments, and that's both a threat if you happen to be long. You've got to keep very, very close watch over margin positions. There's also an opportunity because I think some of the really good stuff can get washed out, on a pure technicality, But I think John makes a good point. I think you can also divide that world and look at it in terms of what are technology assets, what are macro assets. For macro assets, you may as well go ahead and trade the VIX and the S&P, but there could be some interesting opportunities on the tech side.
Yeah, and it's as Danny says, it's all quite correlated because people will hold will hold a portfolio of crypto assets and they'll probably be adding and reducing them in reasonably similar terms, so they'll cut the good stuff and the bad stuff in the same time. So in periods of weakness, there really are some great, if you're a buy and hold investor with a strong conviction over crypto with technology you believe in, it's likely that in these bear market cycles you get some really good opportunities from deleveraging.
Yeah, even when you just look at crypto in general right now, I'm sorry, I don't mean to sound super rosy here, but I look at crypto, it's like 1.6 trillion. I remember in 2017 looking at crypto, it hit 8 billion or 800 billion in market cap and thinking, this is nuts. This is absolutely insane. I can't believe. But now I'm looking at crypto being like only 1.6? Only 1.6 trillion? Sorry, compared to everything else. John, you made this great tweet the other day saying, hey, look, the denominator has changed, right? You got to look at the amount of money that's in the world, right? And relative valuations. And I don't know. I just think, from a high level perspective, there are 4 companies in the S&P that are valued more than the entire market cap of crypto. And that just seems wildly inexpensive to me.
Look, Michael, if you give or take $500 billion, if you said to me, do you want to own all the Ethereum in the world or all the Tesla in the world? I would take Ethereum every single time. I'd probably say the same if you gave me half of Apple, right? Every single time. There's no doubt in my mind.
Danny, who's giving you these options, by the way? Can you introduce it to me?
But no, you're absolutely right. You could flip that on its head and say that for some reason, and it is just something to do with the mystique. It's something to do with the history, the sort of anonymity. And it's to do with, that there's some sort of idea that you don't want to miss, the next part of the internet. But crypto just always punches above its weight in terms of Mindshare, in terms of media share, in terms of hype, in terms of attention from regulators and all this kind of stuff. Always way, way, way above, where it is in terms of actual value. But I think that speaks a lot to what this community is about and what the prospects for it are, going forward. And so you're right. You're absolutely right. I mean, I think 800 billion or 3 trillion, one company, the biggest company, admittedly, but one company in the S&P. I think all of the, tens of thousands of developers building Web3 tech right now add up to more than Apple, personally.
Yeah, I would agree with you. I think one interesting area when you just talk about crypto punching above its weight class in terms of mind share and hype and attention, I think one thing that crypto's kind of proven, if you look at previous cycles, the things that is the most hypey and gets the most attention tends to kind of weirdly predict the future. Not exactly, but it sort of rhymes. So like ICOs, for instance, they were the hypiest, most attention grabby part of 2017. That's a dirty word now, but they were directionally right. The idea of bootstrapping growth by selling ownership in the network, I think that was the right idea. You just got the crappy first version in 2017, and then we improved on it with DeFi and NFTs. NFTs are one interesting area of outperformance where they haven't really gotten the memo that crypto is selling off in general. And what's really interesting about that is that my understanding of why NFTs went up is because the wealth effect, right? People got really wealthy in terms of ETH, and then they start denominating in their head, okay, I'll chuck 1 or 2 ETH into this, this monkey JPEG or whatever. But as ETH is going down, people are repricing. The NFTs are staying where they were, which is shocking to me because on the ICOs were the exact opposite of that, where you basically, they reprice much quicker than Bitcoin ETH on the way down. But I don't know if you guys have opinions on that. I know we're already running high on time here, but
I'll tell you really quickly. For better or worse, for up or for down, there's been a generation of very young, very wealthy people created through crypto that is only going to continue going forward. They do not denominate their wealth in Birkin bags and Ferraris and Gucci handbags, but let's remember, LVMH sells, 30 billion worth of these so-called unique luxury goods to boomers every year to make about 4 billion, I think, in revenue or something like that, big numbers. That is not what the crypto wealthy, young community want. They flex by owning CryptoPunks, EtherRocks, Bored Ape Yacht Club. And that's why you're seeing the crypto price of them rise as the price of crypto goes down. Because there is some sort of fiat component there, and I think these early, the early stage NFTs, there will be millions of NFTs. NFTs are much more than art. NFTs are a two-way channel between a brand and their customer, and it's going to be hugely important. But those early NFTs are going to be the grandmasters of Web3, and you can't make more of them because you can't wind the clock back to 2017. And personally, on dips here, I actually think the originals are a better investment than crypto.
Just one last thing, because it's actually just popped up on my screen, just going back to like our Fed discussion and about activity. So last week there was a really big miss in the Empire Manufacturing, which is like the New York Manufacturing Index, that was the lowest since the pandemic, and actually the overall PMI data, both for services and manufacturing, just missed quite a bit already. So the Fed is tightening into worsening data, into falling inflation. So I really think that you could take some medium-term comfort that the market is not right about the amount of tightening it's expecting from the Fed.
Well, the other thing that we didn't talk about is just the rate of change in general. Like we were kind of talking about this before we got on the podcast here, but just the rate at which crypto has sold off, I think has surprised a lot of people. And I think also, I mean, even the NASDAQ as well. So the indices, US indices are still holding up okay. I think a lot of the growthier tech names have gotten absolutely taken to the woodshed. Like ARK is down, whatever it's down, 70% or something from the highs or something like that. But if you look at some of the COVID era, pandemic era darlings, Zoom has done a full round trip. Peloton has done a full round trip. Lemonade is, 70% off where it IPO'd at. It's starting to, I mean, it's happening very quickly, I think is the point that I'm making too. And if that had happened over a period of a year, maybe the Fed would have looked at that and said, okay, that's fine. But I think it's happening very quickly, and that might make them sit up and take notice.
I think the lesson, if you look back, all the way back to the early days of commodities in the late 80s and the early 90s, the lesson of maturing markets is the repricings happen faster, but the amplitude reduces. Right. So we had periods in the past where crypto would be 1,000 and then it's, it was 3 months later, it's 100. Now, and that might take a month. Now it seems to me like, a week or two, but the amplitude is lower. And I think that's a sign of maturing markets. And interestingly, it's still the case in some of the more speculative coins that the amplitude is bigger and the correction is a bit slower. It just goes on for a really, really long time. Look at where Doge was. They were talking about $1 for Dogecoin recently. It had just bled out down to like 14 cents or something. And I think it's one of the less mature ones compared to Bitcoin and ETH at least. But I think that's what we're seeing. So it's, that's again while I think you can scale a 50% decline in the major coins to being a pretty good correction for everything that we've seen happen so far. Whether, it still feels like nervy in terms of stepping into buy, but you could make a case that the damage has already been done.
Yeah, absolutely, guys. All right, guys, this has been a ton of fun. Thanks for hopping on at such short notice, too. You guys are legends. We'll have to do this again soon.
Give us a little time. Give us a little prep time next time.
I like to keep you on your toes. Fellas. All right.
Good stuff, right.
Cool. All right, guys. Well, we'll see you soon. Thanks again for hopping on.